Welcome to the Snapshot edition of the Daily Video Update. This is being prepared Friday, April 22nd, where I'll briefly go over the high points of what happened in Friday's session, and then we'll look to see how things are for Monday, April 25th. And again, if you want to watch the full-length version of my analysis and commentary for Monday, please look at the full-length Daily Video Update. So, Friday ended up being pretty negative. We started off going down and just kept going. Really, you could tie Thursday and Friday together because we really declined on Thursday and we kind of just picked up where we left off on Friday and just kept going. So we had a negative open. Selling came into the S&P very quickly and took us below S1, which was at about 43, 47, right around that level. Then, as the day went on, S1 became resistance because we broke down below it. Anytime we tried to go back up to S1, we hit overhead resistance, and then selling resumed and took prices down to S2, which was at about 43.01. Prices eventually even broke below S2. We never got to S3. That was pretty far down, but still, a lot of damage had been done. There were some attempts at buying as we got closer to the close, but this was not successful. It tried to get us back above S2, but it just wasn't happening. We closed almost at the low on Friday, and we ended up being down in the S&P 2.77%. The one thing that's kind of positive from this is on a heavy down day, volume was just slightly below average. We didn't see a real big buildup of volume as this was going on. The technicals right now, of course, are negative. I'll try to point out some bright spots as I can. The big thing that the markets are fixated on is inflation and interest rates. That's really at the forefront right now. We do have all the different geopolitical concerns as well as a lot of earnings reports that are coming out. The ones that came out on Friday just didn't really excite the markets all that much. So Thursday's selling continued into Friday. The technicals are negative, but we are oversold, at least in the short term, and a few of our intermediate term indicators are also oversold. We're back into correction territory now. We're down over 10%, the way I calculate it. The earnings that came out just didn't excite the market, as I stated. And one thing I did run across is that Germany, which is the biggest economy in the EU and pretty robust, they actually lowered their GDP forecast. It had been at 3.6%. They lowered it down to 2.2%. And that really set Europe off to being a lot more negative, and that carried over into the U.S. session. The 10 to 5 yield curve is still inverted. The 30 to 5 that I talked about yesterday, that went back to being normal again. So we have one out of all the different yield curves that I look at that is currently inverted. And then there's a lot of people out there that are constantly negative. They just say the next crash is right around the corner. Some of these people I've been listening to for over 20 years, and they're always saying the crash is coming, the crash is coming, the crash is coming. I call them perma bears, just like there's always perma bulls, the people that are always optimistic. Well, the bears are really euphoric right now. They're like, see, told you so. Well, if you keep saying the same thing over and over when it comes to the stock market, eventually you're going to be right and you'll pat yourself on the back and think you're a genius. So they're pretty happy right now. I follow a couple of different people that are always negative. And man, they're not negative right now. They're happy. They're like having a party. The economic report that came out, I thought might have a little more impact on things, but part of the report was down, part of the report was up, and it really didn't have an influence. And we're looking at what could be a new trend that is developing. And this trend is looking to be negative right now. So our bias is negative since we had a down day, and our momentum over the last few days is also negative. Here is the VIX. And the reason I bring this up is because we really spiked up. There was a great increase in fear. This is the line chart, and then here's the bar chart right here. And I'm trying to include some more labels on the charts as well, because I go through so many charts. But just know that fear really, really climbed on Friday. And then another thing that I don't show very often is called the equity put call ratio. If this is going up, that means people are buying a lot of puts. Puts are used for protection. Puts increase in value as the market goes down, where calls are the inverse. They increase in value as the market goes up, or as their value goes up. Well, we're seeing a real spike. And if you go back and look at other times when the put-call ratio really spiked up like this quite often marks some kind of a significant bottom. So we could take this as potentially positive. It might wear off for a few days and then the market may continue lower, but this also might suggest that we could see some kind of a rebound, at least an attempt at a rebound on Monday. Then right now it's 99.6% certain that we're going to have 0.75% interest rate up to 1%. That's a 50 basis point move, or 0.5% increase from where we're at right now. Then this is how it looks on the chart. We came down and we're right about at this intermediate term support, but we even broke through that a little bit. So that's one thing to be aware of. Down at the bottom is that we're just a little bit below average as far as we calculate the average volume. Then this is the new trend. The ADX is starting to turn up. Now, if you're a little more aggressive and you want to use this, when the two lines cross, you can say, okay, we're already in a negative trend. Other folks that are a little more conservative, that take more of a wait and see attitude, they want the ADX to go back above 20. And I have some videos and some articles on my blog where I talk about the different ways that you can use the ADX. But since the red line is on top, that's what we would default with right now, because the green line is declining. So this is why I just say it's developing. If you like this, you're like, the trend's already here. I'm going for it. Where others say, let's just step back a little bit. Another thing that really shot negative is the Arun. It really hadn't been helping us all that much. Well, with Friday's decline, the red line really shot up. And when it's pegged near the top, that means that sellers are in control. And when these lines cross, the green line is going down. That's buying. Buying is decreasing. Selling is pegged at the top. When you compare both of these together, our oscillator dropped below zero and is declining. So this shows that we're in a highly negative environment. We're also looking at our rainbow charts. I only have the longer term chart this time. We've fallen completely below the rainbow, but we've fallen below this before. Now, some people can look at this and go, wait a minute, that might be an inverse head and shoulders bottom. I'm not saying that is, but you could make a case for that. Here's the left shoulder. Here's the head. Maybe we're forming the right shoulder now. Just something to be aware of in all of this. We are below the 200-day moving average, so our long-term trend is negative. The dollar just continues to really do well. This is the weekly chart, and we finished above 101 on Friday. Here's the one yield curve, the 10 to the 5, that remains inverted. It's below this line. The other one switched back, and we're just going to have to keep an eye on that for right now. And then I've been pointing out where there's a pretty strong inverse relationship between tech and interest rates. The red dotted line, that's interest rates. The black line is tech. Usually as it's been going up, tech has been going down. Well, the closer we get to -1, that means the stronger the inverse relationship is. We're starting to lose that a little bit. It's not as strong as it was before. So if you're really watching interest rates closely, which is always a good thing, it doesn't necessarily mean tech is doing the exact opposite right now. It could switch around and go back, but right now that relationship is not as strong as it was. And then we're also waiting to see where here is staples. This is a ratio of the staples. When this spikes, a lot of times that marks a bottom in the S&P. The only problem is we don't know if this is a spike. We could have said, well, it spiked back here. No, it spiked here. Well, it really advanced on Friday. We don't really know when this is going to happen. So that's why I have the question mark here. So this is just something to be aware of, just something to watch. We'll probably put it in our bag of things that we look at. And then when it comes time to make a decision, we combine that with other indicators to say, okay, this is confirming that maybe we are at a bottom and we're going to go higher from here. So what's our outlook then? The technicals are negative. Our short-term and some of our intermediate-term indicators are giving us oversold readings right now. The market remains pretty trendless if you use the more conservative approach to the ADX, and we're in an intermediate-term range. The battle between growth and value just goes back and forth. We still have supply chain issues. They're not really at the forefront of what the market's fixated on right now, but they're still there. There's really no economic reports coming out on Monday, and then here's the whole list of geopolitical events. Russia, Ukraine, China, supply chain, inflation, and interest rates. That's the biggie right now. Who knows what it will be in this coming week? Oil, different earnings that are coming out. And then as the Fed folks give their speeches and make comments, a lot of this is being taken as negative. There was somebody that came out on Friday with something that could have been seen as positive. The market pretty much ignored that. But we don't know if maybe on Monday they'll decide that everything's going to be fine and they'll like what that Fed person said. So here's our scenarios. And I have 1 and 3 both in yellow because we're kind of in both of those areas depending on how you use the ADX. We are negative and we're watching for rising interest rates and inflation fears. That could really continue the downside that we're seeing. Earnings could also do that, as well as any Fed speak that spooks the markets. Then I'm going to jump down to number 3, sideways. The ADX is still below 20. So you might still be more sideways leaning right now, but it's starting to climb and it will be showing, if it keeps going the way it is, a negative trend. And when we're in a sideways environment, we see a slowdown in price movement. Yeah, try to explain that to people on Friday. But we really didn't go anywhere. We've been at these levels before overall, and it tends to get pretty choppy. So take your pick. Are we still in a sideways environment, or are we getting ready to go even lower from here? The positive one, number 2, we might get a bounce because we're short-term oversold. And this positive backdrop after the yield curves reinvert, that's not there right now. One of our yield curves is still inverted. And then the staple spike. We don't know if that's the actual spike yet. Our technicals, some of the moving averages, we've dropped below a lot of them right now. But in some other indexes, we may find support as well as some pivot points that can provide either support or, if we get a bit of a bounce, may end up giving us some resistance. So our conclusion is right now the S&P is negative. You can't really argue with that. Short term, negative but oversold. Intermediate term, negative and partly oversold. Our oscillators are negative and below a lot of important moving averages. And then long term, we are below the 200-day simple moving average. Here's a list of the other videos. If you find this interesting, please go and watch the full length if you feel that will help you. So thank you very much. Have a great weekend, and I'll prepare the next snapshot update after Monday's session.